Hi everyone, it's Paul Tilley. Welcome back. Today we're doing an example problem. And the example problem will be much money consulting. Now, much money consulting, it seems like a pretty straightforward problem. In this problem, William Curtis is a personal finance expert who owns Much Money Consulting. This is his first month of operations, and William has hired you to do his accounting. The following transactions are for the month of October. And effectively what we need to do is what's being asked is to complete the unadjusted trial balance. So in order to get to the unadjusted trial balance, we must know that the very first step that we do in accounting is to journalize the entries. And what we mean by journalize is to adjust the various accounts, debit and credit them according to what needs to be done. So let's take a look really at the first one to get a sense of how to do this. So on October 2nd, William Curtis invests $32,600 cash in his business. Now, if you recall, if you go back to the first chapter, we'll see that really debiting and crediting, we have to understand when accounts are adjusted, are they debit or credit? Well, in this particular case, first thing we need to do is determine a couple of accounts that are affected here. So William Curtis invested is that by definition is a capital account. When he puts money into the business, that creates a capital account called William Curtis Capital, and that effectively went up by $32,600. And cash came into the business, and cash would be the other account that's affected. That went up by $32,600. Now, if you look at the chart, you'll see that cash is an asset, and assets that are increasing are debited. Debiting increases an asset. So the very first thing, and traditionally we put the debit first. So we're going to type in cash under the category here for debit. Cash will be debited, and it will be debited for $32,600. The credit, and we indent the credit a little bit, so I'm putting it in the next box, will be for William Curtis, WC, and it will be capital. So that will be the other account. So these are the two accounts, and that will be credited for $32,600. Why is it credited? Well, by definition, a capital account, which is found on the other side of the balance sheet equation, capital is an owner's equity account, and if we increase our owner's equity, it is by definition a credit. So this would be the journal entry for the first item. Let's move to the second item. On October 4th, purchased $925 of office supplies for cash. Well, let's say, what are we looking at here in terms of the accounts? Well, the first account is office supplies, and the second account is cash. So we can define the accounts. What's happening to those? Well, in this case, he went out and bought $925 worth of office supplies, so we know our office supplies went up. We got a whole cabinet full of office supplies now, $925 worth. We know that office supplies are an asset, and when assets increase, in order to increase assets, that is a debit. So we need to debit office supplies. And that will be debited for $925. Now, he paid for it with cash. This means our cash account went down. You know, we took money out of our bank account in order to pay for that. By definition, when an asset is decreased, that is a credit. So we're going to credit cash. You notice it gets indented for $925. Okay, that's our second entry. Let's take a look at the third one. On October 6th, he purchased $13,600 of office equipment on credit. So there's two accounts here. The office equipment went up. That's an asset. Office equipment is an asset. By definition, an increase in an asset is a debit. So we're going to credit office equipment. And it will be for $13,600. And the other account is we purchase equipment on credit. Whenever we do that, that's accounts payable. That's an accounts payable. By definition, that's the credit account that we have. We buy stuff on credit. It gets put into accounts payable. And this is increasing the credit. In other words, the amount of money we owe is going up. By definition, that is a credit account. So we're going to credit accounts payable by $13,600. So that's that one. On October 10th, he received $3,000 cash as revenue from being a guest on a TV show. Okay, well, let's look at it. He got cash come in for $3,000. That's an increase in cash. Now, an increase in the asset cash is debited. That would be a debit. So we debit cash by $3,000. And the other thing, it says revenue. So he's getting some kind of a revenue in here. So we'll just call that a revenue account. And an increase in revenue is a credit. So revenue, 3,000. Okay. Now, on October 12th, paid for the office equipment purchased in this transaction right here. So effectively, he's going to pay for it now. So we've got this one here. It's $13,600 worth of equipment. There's an accounts payable there. So he's going to take cash. So cash is going to go down, and the accounts payable is going to go down. Now, if the accounts payable goes down, that will be a debit to accounts payable, which will effectively wipe this accounts payable out. So first of all, accounts payable for $13,600. And cash is going down too. Cash is an asset. Decrease in cash would be a credit. So that would be the journal entry for that one. Okay, on October 16th, he billed a customer for $5,400 for delivering a corporate workshop on smart investing. So he billed the customer. There's no indication of any money or anything like that. What we're doing instead is recognizing that he earned revenue. Okay? So this is an accounts receivable and revenue. Now, accounts receivable is an asset, meaning that he's put out a bill for money he's going to get. So that's going to increase that asset. So accounts receivable, I'm going to just call it AR for short. And that's going to be debited for $5,400. And we're going to credit revenue for $5,400. And that would be that account there. On October 18th, he paid October's rent for the downtown office of $3,500 cash. So he's paying rent. That's a rent expense. And he's paying it out of cash. Now, an expense, when you incur an expense, that is a debit. So we're debiting rent expense. And that will be for $3,500. And we are in the process of reducing our cash because we're paying it. So cash is going to credit. Reduction in an asset is credit. $3,500. Okay. Let's take a look at the next one. On October 26th, he collected cash for accounts receivable created in transaction F. So transaction F is up here, where there was accounts receivable and revenue. So basically, there's $5,400 coming in. So we're getting cash of $5,400, which is a debit. And the accounts receivable is being reduced, so that will be a credit to accounts receivable by $5,400. Finally, he withdrew $5,000 cash from the business for a trip to Hawaii. So in this particular case, he's pulling money out of the business. So if we think about it, that's an account called withdrawals. So WC withdrawals. And seeing its money pulled out of the business, it will be a debit. We're reducing his owner's equity. And so that would debit it for $5,000. And he's taking that money out in cash. So cash goes down. Cash is an asset. Any reduction in cash is a credit. So, and that would be for $5,000. So there you go. There are all of the entries that we had to make for this. So We've got them all journalized now. Now, what we need to do now is to take the journalized entries and place them in our T account. So down here, I have created some T accounts. Just to make it simple, I've done this ahead of time. So these are just the T's. So let's just plug them in. So let's go up to their very first entry. Cash, debit, 3260. Okay, let's look at it. So what we do is we go down to our T account and we put cash for 3260. It's on the debit side, 32,600. Then we come up to working capital. Working capital was 32,600 and it's credited. Now, you'll notice that I have set up the accounts in an order here. I put all the asset accounts, then I put all the liability accounts, just line them up. These are all assets, these are all liability, these are owner's equity, and this is revenue and expense. So in this particular, the next particular account was 32,600. Let's just go back here. This is a capital account. It was credited for 32,600. So let's go find the capital account. There we go. And 32,600. So we put that in. So effectively, what we've done is we've got a debit and credit. There's our first one, put in our T accounts. Now, then we go back and we look at our second one. Office supplies, debited for $925, cash credit for $925. So let's go find our office supplies accounts. Office supplies, debited for $925. And the other account that was corresponding to that was cash. We took money out of cash, so we're going to go for $925. So we credit. So all this is really doing is keeping a tally of the account. So that's what the T account does. So like here's the cash account. We put money in it. We've taken money out of it. So it will give you the balance in the account effectively. That's what the T account does. It's just more or less gives you the account balance as we move through. So I've got this second one put in. Office equipment, 13.6, and accounts payable. So let's go down to our T account and let's find our office equipment. Not to be confused with office supplies. Office equipment. So we look at our office equipment here. Office equipment is 13,600 debit. And that office equipment, you will notice when we bought it, we paid an accounts payable, so it was credit for 13.6. So let's go find accounts payable. And we credit for 13,600. The next one, we had cash debit and revenue credit for 3,000. So cash, we'll go down to our cash account. There was debit, 3,000. And revenue was for 3,000. So let's go find a revenue account. 3,000 credit. Okay. Okay, now we look at October 12th, our accounts payable, 13.6, our cash credit, 13.6. So accounts payable, debit, 13.6. Our accounts payable. Now let's find our accounts. 13, we got our accounts payable, cash, debit, credit for 13.6. So all I'm doing is taking them and putting them in the respective, if it was credit, so this keeps a tally of what the balance is in the cash account, right? Okay, so this, then we're looking at the bill to customer, so accounts receivable, debit 5,400, revenue credit 5,400. Accounts receivable, debit 5,400. And revenue credit for 5,400. Okay. Then we have rent expense 3,500, cash $3,500. So rent expense, debit. Rent expense, debit, $3,500. And cash, credit for $3,500. Okay. And then next one we had cash, debit, $5,400. And accounts receivable, credit for $5,400. Cash, $5,400, debit. 5400. So that adds to our balance. And accounts receivable, credit 4,500. 45 or 54? 54. Notice that the accounts receivable account now is zeroed. The balance is zero because we had the accounts receivable set up, then they paid for it. So you can see what these T accounts do is just, again, calculate the balance in the account. Finally, we got a withdrawal of $5,000 and cash went down by $5,000. So withdrawals, debit for $5,000 and cash $5,000 credit. Okay, so now that we've done that, now that we've done this, so we've got our T accounts done. Now I'm using a spreadsheet now, but this can be done manually as well. But the fact of the matter is, the balance in our cash account now is $17,975. The balance in our accounts payable account is zero. The balance in our capital account is $32,600 credit. So we're sitting on the credit side. The balance in the revenue account is $8,400 credit. So you see how this works. So what we're going to do is we're going to take the account balances now. Now the only reason that's negative is on the credit side. So we're going to take our account balances and we're going to place them in a trial balance. So all a trial balance is takes each individual account and it puts the balance in. And depending if the balance is debit or credit, and that T account and that account. So here what I have the trial balance. I've listed down all of the accounts. Okay, listed down all the accounts. So let me just go and see what the cash balance is. So I go up and look here in cash. Cash is $17,975, and that is in a credit balance. The balance in that is debit balance. Why is that? Because there was 41,000 total there, 23,000. So this is in, this is out. So there's 17,995. That was a mistake I made there, but that's 17,995 in the debit balance. So what we're going to do is take that amount. 17950. No. 17975. That's the balance. Just double check that again. Okay. Now I'm going to do the same thing for every other one. So I'm going to go down to my accounts. This is why you should line them up. Makes it easier when all the assets are together. So accounts receivable, balance in that one is zero. So there's really nothing we need to do in that. Normally, asset accounts will have debit balances. Office supplies. Let's take a look at the office supplies. Look at that, 925 balance. Office equipment. We look at office equipment, 13,600 balance. Now that's all our asset accounts. Now let's go over to accounts payable. Accounts payable, normally they would have a credit balance, and notice that the balance in accounts payable is zero. So there's nothing there. Let's take a look at our capital account. The capital account has a credit balance, and again, most of the time the capital account will have a credit balance of 32,600. Now we look at the withdrawal. He took 5,000 out, so that gets on the debit side to 5,000. And we look at revenue. Revenue we see, which would normally have a credit balance, $8,400. And we saw that the expenses, if we look in our expense account, it has a $3,500, and normally that would have a debit balance of $3,500. Now, so this is what we call our unadjusted trial balance, meaning we haven't done any adjustments at the end of the period in terms of depreciation or anything like that. So non-cash changes effectively. So let's look at the totals here. We total them up, 41,000. We total them up, 41,000. We know that it's done right because the two balances are the same. That was what we were required in that question, was to do the unadjusted trial balance. There it is right there.